All right, so let's talk about Silicon Valley Bank. And this is interesting because I did not include it in my timeline here. Here's my little timeline of what happened. But interestingly enough, Silicon Valley Bank was either on the cover of Forbes magazine in February or was in one of their articles as one of the best run banks and best investment ideas for the future, yada, 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 in as most recently as February of 2023. And then I think we're all familiar with the rapid collapse. So let's talk about what caused that, what dynamics started it and the snowball that went in motion. And then let's talk about some areas of the economy or the market, if you want to call it that are potentially the next shoe to drop, if you will, or areas of risk. I have to start out by saying I'm not a banking expert. I'm a finance guy, investment guy. But when I was reading through all the different research I did to put this presentation together, I found some really fascinating stuff. And there was some serious warning lights that were flashing out there and some serious insider trading based on knowing that there were some serious problems with the balance sheet of Silicon Valley Bank. And unfortunately, there's also a political angle to this as well. I mean, you know me, I try to stay away from politics as much as possible. But I think you'll see when it comes to the political realm. I don't want to offend anybody, but I think there's certainly some stuff in here that we can trace back to government and not so much Silicon Valley Bank itself. All right, so let's talk about Silicon Valley Bank. First of all, it was one of the fastest growing banks in the country. I put up here in 2018, their assets at $49 billion. By 2020, they had $102 billion, so it doubled in size. 2021, they almost double again in 1 year. And by the end of 2022, the cracks were starting to show, and the assets had actually fallen to $175 billion. Well, what coincides with this time frame, 2018 to 2022, is unprecedented low interest rates. Basically, low interest rates in quantitative easing. Basically, an absolute spigot of capital being thrown into the markets, and I'll explain a little bit deeper here in a second. But historically, interest rates at zero is an anomaly. Yes, we were there coming out of the Great Recession and the financial crisis, and then they stayed low for a while. Then the Fed began to raise interest rates. We'll go over that here in a second too. But then we went back to zero interest rates based on the pandemic. And not only that, an absolute flood of stimulus into the economy from not only the Fed or Federal Reserve, but also from the government. So from the fiscal side too, from the Congress and president from 2022. And as you'll see here in a little bit, that is actually what led to both the rise and fall of Silicon Valley Bank. Interestingly enough, in November of 2022, as you can see here, JPM, which is JP Morgan, warned that $16 billion in unrealized losses could pose a serious risk to Silicon Valley Bank. They actually went to regulators and said, from my research, said, hey, this bank, which is the 16th largest bank in the country, which is on the border of being systemically, when I say systemically, I mean it could take down the whole system, is on the border of being systemically important, meaning too big to fail. You should probably take a look at this. This is November of 2022. In February 2023, the CEO, Greg Becker, began selling off company stock that he had that was unrestricted. They have these stock trading plans called 10b5-1s, and they get these windows where they can sell stock. Well, he had not sold stock in over half of a year, probably because of the large growth in the assets. Well, in February of 2023, this is insider trading, but legal insider trading, he sold as much as he possibly could in his 10b5-1 trading program, which led to a $3.6 million cash out for him. All right. Then on March 8th, 2023, Silicon Valley Bank calls Goldman Sachs, and they seek to raise $2.25 billion in cash through issuing more stock, which usually when a company issues more stock, it raises red flags all around the company. Why do you need more capital? What's going on with the balance sheet? What's going on with your income statement? What's going on with your capitalization, especially in the banking industry, right? Where banks take in money most simply and then lend it out or hold it and invest it in safe securities or quote unquote safe securities. They're not allowed to invest in the stock or the equity market. But it definitely raises eyebrows when a a bank is seeking to raise capital without having previously announced that they were going to do a capital raise to, maybe purchase another bank or something like that. So this raised a lot of concern. And then the snowball began. On March 9th, there's a call between CEO and concerned investors. And I'll go over who most of those investors were here in a second, but just to kind of jump ahead in the presentation, we're looking at mostly venture capitalists, private equity firms that keep a lot of cash on hand to make immediate investments or support the companies they've already invested in. A lot of startups, right? A lot of Silicon Valley-based tech companies that are startups, rapid growth, need a lot of cash to fund that growth, right? And so if a PE, a private equity firm, or a venture capitalist is taking a stake in that firm, right, they need to be able to provide the cash that it committed to. So they keep this cash on hand at the Silicon Valley Bank. On March 10th, so only 48 hours after they were looking to issue stock through Goldman Sachs, secondary offering of their stock, the regulators walked in the door midday and took over the bank. The California Department of Technology and Regulation stepped in and shut down the bank and said, we are going to they can't guarantee depositors, but we're going to reach out to FDIC, Treasury, and the Fed, and we're shutting this bank down now. No deposits will leave the bank on this Friday, which is a big deal. A company like Roku had $600 million in cash on hand at Silicon Valley Bank, which begs to ask, why do they not have a cash management expert, someone in my industry that's putting money into treasuries, this and then the other, or overnight repos or commercial paper or whatever it happens to be to get money or to get return on that cash? Because you can't imagine their payroll $600 million, right? So why were they keeping that much cash? Maybe they were looking to buy somebody, who knows? Bottom line is, a lot of companies were not going to be able, and not just big companies, but small, mom and pop shops too, right? That were lent money to Silicon Valley Bank, or that were keeping their cash on hand there for their corporation, right? And so March 10th, regulators take over the bank after a run on deposits, people requesting all their money back. And then, I don't know if most of you know, but most banks don't keep more than 10% of the electronic deposits on deposit versus the amount of cash they actually have at any given time. Sometimes it's less than 10% of the value of their quote unquote deposits. And so you get a run on a bank, you get a loss of confidence, and a Silicon Valley Bank happens, right? Treasury and Fed on March 12th, Sunday, come out and say, we're going to guarantee all depositors, secured and unsecured. We'll go over those numbers in a second, Silicon Valley Bank. And then most recently, a couple of days ago, First Citizens Bank out of North Carolina, which is also a bank that's heavily in the venture capital, private equity, and tech space, has agreed to acquire all the assets of Silicon Valley Bank and their depositors at a significant discount, with the Fed and the Treasury making up the difference and taking the losses for First Citizens Bank to make that acquisition. So what caused the run on the bank? First of all, banks in the United States are built on confidence, right? The confidence not only that the government's going to backstop your deposits up to $250,000, supposedly, FDIC, or if you're in a larger bank, one of the reasons my firm does all of our clearing and all of our banking through Wells Fargo is because Wells Fargo is the largest, third largest bank in the country behind JP Morgan and Bank of America. Systemically, after the financial crisis, allowing Lehman to fail and WaMu to fail, the Fed has realized that there are banks that are called systemically important to the overall banking system. Too big to fail is what it's called in layman's terms. The Fed's not going to allow these specific banks to fail because it would cause such a ripple in the overall economy that it would be an unstoppable chain of events and a run on all the banks, which is what happened in the Great Depression. They're not going to allow that, and so certain banks are considered what are called systemically important. One of the reasons my firm clears to Wells Fargo Clearing Services. They had a very concentrated depositor base. I have a breakdown of that shortly. This is what we're going to go over. They had a liability issue, extreme reliance on institutional funding rather than you and I, myself and Ron and Vanya and Chris and everyone else on here, depositing our checking and our savings. They had very few clients like us. Their clients were institutional clients. When I say institution, I'm talking about corporations. I'm talking about venture capitalists. I'm talking about private equity firms, angel investors, extremely high net worth people. So that was the base of most of their deposits. And then probably the ultimate undoing of them was the gross duration mismatch between their high quality assets and their deposit liabilities. I'm going to go into that in detail because I think that's the really big story. And then fundamentally, at the end of the day, if you really, really want to point fingers, it's purely management, right? Horrible risk management by who was ever running their investment pool. not understanding. I think it's been pretty telegraphed, the rise of interest rates by the Fed over the last year and a half. They've been very clear what they were going to do. They were going to combat inflation through rising interest rates, and to have a bunch of long duration assets, long duration bonds on your books and not be mitigating that risk in the marketplace was really, really poor risk management and poor investment management by the managers at Silicon Valley Bank. But let's go back to the genesis of really, really where this all came from, right? If we look fundamentally at the genesis of the crack in this particular bank, it started with central bank tightening. And central bank tightening is a result, right? So if here's the Fed funds rate back in the early 2000s, 6%. It comes down in recession. It goes back up into the mid 2000s. Then we have the financial crisis. And then look at this period of zero interest rates. People get used to free money, 2.5%, 3% mortgages, right? Rate of inflation is roughly 2%. Mortgage is 2.5%. You're essentially inflating your way out of a mortgage, right? I mean, it's incredibly low. You could borrow against your portfolio at 2%, 1.5%, 1.15%, whatever it is. Incredibly low interest rates. So the Fed begins to raise interest rates in 16 and 17 and beyond to begin the tightening process, so that free capital, right, is not out there finding its ways to the very, very speculative corners of the market. What also coincides with this zero rate interest rate environment for this long extended period of time? Technology, a leader in the market, because again, technology stocks are long duration stocks, meaning that they don't pay a dividend. Typically, it takes a while to get your money back. And so investors require much bigger growth and a higher rate of return. In a low interest rate environment where there's no alternative, that works, right? And here we return to that super low interest rate environment right after the pandemic again. But then look at how steep this line is. It's the fastest tightening cycle ever in the history of the Fed, right? And what was the genesis of that? Well, first of all, what did that cause? It caused the sea change in global monetary policy, resulted in the first bear market for sovereign bonds. Sovereign bonds are just bonds issued by a nation since 1949. This is your world government bond weighted index return. I mean, look at this, right? A complete collapse in bonds last year. And what was the genesis of that? Inflation, right? Inflation that started right after the pandemic. And again, I'm not here to offend anybody. I'm here to tell you what caused that inflation, or what I believe caused that inflation, was massive overreach by the government, massive overreach by the Fed to support the economy during the pandemic. You may say, well, yeah, we went to record unemployment and super fast. And I would say, absolutely, something needed to be done in March, April, May, June, July, August of 2020. We needed to put our foot on the gas, lower interest rates, get people back into jobs, all those things. But we did not need to have our foot on the gas for the next 18 months. And then to top it off, the Congress passes a bill to throw another almost $2 trillion of stimulus in the form of Build Back Better or whatever it was. And so that money, along with student debt moratorium, along with rent moratorium, along with extended unemployment benefits forever, caused a massive amount of money to flood into the U.S. economy. It's why a restaurant or any, call it blue collar job, had such a hard time finding employees, because people were making more money, quite frankly, on unemployment. All right. Or they didn't have to pay their mortgage and they're getting an unemployment check. I'm just going to stay at home and I'm going to go on Robinhood and, gamble my money in the market. And so that confluence of events, the Fed, over government stimulus, all these programs designed, PPP, et cetera, was just a massive amount of spending. I think upwards of $6-7 trillion in 2 years that went into the economy. And it overheated the economy to where the point where was the S&P 500 in January of 2022 was trading at a 21 times multiple, which is pretty much equivalent to the dot-com bubble era. We've gone over presentations where we've discussed, the big bubble that was in the large cap, mega cap tech stocks. We talked about the Bitcoin bubble, all these other things. But now the ramifications are coming home because of inflation. And if we look at last year's return in 2022, this is the stuff that banks have to invest in, right? So they have money, and if they don't lend it out, which typically when a bank fails, it's because of bad credit. They've made a bunch of bad loans, like the housing crisis, that people can't pay back on. And so all these quote unquote assets, these loans that are on their balance sheet disappear or get written off, and now they don't have enough capital. So that's the typical reason a bank fails. This was the direct opposite. This was they were taking all the money in from the VCs and venture capital stuff, and they're investing it, and they put it in these 30-year treasuries in 2022. Remember that growth I talked about for the bank, right? They go from 102 billion to 189 billion. They have to put that money somewhere. They have to invest it. But they're not a bank that does a lot of commercial loans. They don't do a lot of residential loans. They're a bank that needed to put it in the market. And when you have a 30-year treasury, because the Fed had to raise rates so fast because of inflation, which was a result of government policy, right? Government seems to be the genesis. Doesn't matter if Republicans or Democrats. Government seems to always be the genesis of the problem, right? Back in the mid-2000s, when it was a Republican president, it was easy lending on houses, this and the other. And quite frankly, this problem, in my opinion, is because we put too much money in the economy. Thank God we didn't do a $3 or $4 trillion plan. This problem, because the bigger the bubble is, the bigger the burst, right? And so we're probably headed into a recession here. We've said, first, second quarter, probably now third, fourth quarter. The bottom line is this particular bank was not your traditional bank, mom and pop lending, deposits on hand, all of us here in this presentation. This was one that had big institutional clients, and they had to put that money to work. And when that money they put to work is down 33% in 1 year, so they're still showing all those treasuries on their balance sheet as an asset, and they're not marking them down to their current asset value. But some smart people looked at those balance sheets, realized what their investments were, and said, this bank's going to have some serious problems if they start getting people asking for money and they need to raise cash by selling off their portfolio, which is exactly what happened. So let's talk about Silicon Valley Bank specifically. Here's the private equity bubble that I was just talking about. You can probably do the same graph for venture capitalists. Look at the announced transaction, falls off of a cliff with the rising of interest rates. Fundraising falling off of a cliff, right? So now they don't have new funds coming in. Their transactions are going down, and they have to support the companies, the very companies that NASDAQ was down 33% in 2022. The average or median NASDAQ stock was down 54%, I believe, or in the 50% range. So a lot of these companies that they're helping fund, and I realize NASDAQ is public companies, but I'm making an analogy to the private sector. Their valuations are down significantly. They don't have cheap cash funding their operations. So these private equity firms and venture capitalists need to go to the bank where they got their cash deposits, and they need to start helping fund or help these young companies survive. And so you get a run on the bank and bank deposits. Here's unrealized gains and losses on selected securities. Silicon Valley Bank, if you look at the structure closely, was their unrealized losses on their securities was upwards of 16, 17, 18 billion dollars in unrealized losses, meaning you buy something for 100, its price is 80, you have a $20 loss, but you're not realizing that loss because you're not selling it. Okay, so that's what Silicon Valley and smart investors realize this is happening. By the way, this is the rest of the banking system. We're not out of this yet, right? There's upwards of 550 billion in liabilities on bank balance sheets. When I say liabilities, it's unrealized losses that they don't have that they're showing on their balance sheets that they have. This is a big problem. It's going to take a while for this to unwind. And the only thing that's going to get this to reverse quickly is by lowering interest rates rapidly. You lower interest rates rapidly, you put more money in the system, and inflation comes back. So now we have a big problem. And that's why inflation is so bad, especially rapid inflation, and flooding our economy with trillions and trillions of dollars is a really bad idea. Here's Silicon Valley Bank, specifically the U.S. bank loan to deposit ratios, estimated retail deposit shares. So this is the estimated percent of your lower risk deposit base, meaning mom and pop, and your higher risk deposit base, meaning private equity venture capitalists. And Silicon Valley Bank was over here off the charts. Okay, it's in the bottom right corner. The highest risk area is where they were. Obviously, they don't exist anymore, so they're not there anymore. But you can see some of these other banks are probably in a particular bad position as well. Here you have the more traditional banks: J.P. Morgan, Regions Financial, Wells Fargo, et cetera, et cetera. A couple other issues. Silicon Valley Bank deposit funding. Who were their depositors, right? Early stage technology, which got crushed in 2022, was 30%, right? So they're going to be digging in for money left and right because they're funding their operations because of how bad the market was, right? Their equity was chopped in half. Technology, another 20%. So that means 50% was in high-risk technology. You've got life sciences, healthcare, early stage science, healthcare, et cetera, et cetera. And you can see here, the private bank and deposits, right, was a very, very small portion of their overall deposits, which created the run on the bank. Impact of unrealized security losses on capital ratios, right? This was as fourth quarter 2022. Look at all these different banks where you have what's called the equity tier 1 capital ratio, and it's adjustment for those unrealized losses in their long-dated, whether it's mortgage-backed securities, asset-backed securities, or treasuries, whatever they're investing in. So the difference between what they're showing as their capital ratio and what the value of that would be, right? This is why UBS was in trouble just recently here, right? First Republic, here it is right here as well. But look at where Silicon Valley Bank was, right? The difference between what they were showing as their capital ratio to what it was adjusting for unrealized losses on the securities they invested, right? And this is exactly how you get the genesis of a bank failure. Balance sheet growth, quarter 1, 2019 to 2022, Silicon Valley Bank, number one, 250%. The very thing that made them the darling of the banking industry is what unraveled them, right? As you have super low interest rates, private equity, venture capitalists, depositing money at Silicon Valley Bank, everybody's getting rich. And when interest rates reverse and Fed policy goes the other direction and goes the other direction very quickly, the reverse happens. Everybody pulls the money out of the bank. Now the bank is not capitalized enough to be able to support those depositors taking their money out, right? Here's their asset growth, right? Tracking with the IPO cycle. You can see here, they quite simply decided to make their bank the preferred choice for this extremely risky part of the market. Oh, by the way, if you want to know why Signature Bank failed, you could do the same overlay with Bitcoin, right? Instead of IPOs, they were into funding Bitcoin companies and Bitcoin operations. That bubble burst. The banks that were most associated with that or took the most risk with that also burst. This is the same thing that happened to Silicon Valley Bank. Bottom line, Silicon Valley Bank carved out a distinct and riskier niche than other banks, right? They had that niche of supporting venture capital, private equity. We want all your deposits on hand. We're going to give you a little higher interest rate on those deposits, and you're going to get at Wells Fargo or JP Morgan or Citibank, right? Because we're going to take that money, we're going to invest it in long-dated treasuries. That works fine and dandy in a zero interest rate environment, but when interest rates go skyrocketing, a bond, remember a bond is just like a teeter-totter. One side you have interest rates, the other side you have price, and the further you are on the edge of the teeter-totter, the more they move, right? And so if you're owning nothing but long duration bonds and interest rates go skyrocketing, the price of that bond goes the opposite direction. So it carved out a distinct and riskier niche than other banks, setting itself up for large potential capital shortfalls in case of rising interest rates, deposit outflows, and forced asset sales. So with that, I'm done with the Silicon Valley. Let's talk real quickly here about, and if you have questions about Silicon Valley Bank or any of those charts, I can go back to them. Where are the areas that this rising interest rate environment is really looking like to start to develop cracks in other parts of the economy? Right, well, this is just straight out of the Wall Street Journal, right? Data shows worrisome trends in real estate, banks, and private markets. The market value of securities and percentage of cost, meaning people bought them at 100%, and the market value now of those securities, particularly real estate derived securities and treasuries, mortgage-backed securities, asset-backed securities, are now all underwater. So companies, REYTs, et cetera, that have those on their balance sheets are at risk. Commercial real estate risks are rising. Here's the U.S. office vacancy rate, right? Come down here, the pandemic. Well, you figure we're out of the pandemic, offices would start putting people back into those offices and there'd be more availability. Nope, it's done the exact opposite, right? There's been more availability as more of us like myself, work from home in the middle of a huge snowstorm again up here in Tahoe, right? I'm not driving into an office. In fact, we have a couple offices, but we do the office sharing thing because it's a much cheaper way to run our business, right? And we don't need it with the advent of Zoom presentations and doing Zoom client meetings, et cetera. Also, newly built and occupied office space. Right? Look at all this newly built office space. Net office space absorption is negative last year and barely even off the zero mark here so far this year, right? So more office space coming online and not absorbing any of that office space. That's a problem. Here's the quarterly value of bank loans and securities. right? You can see they're all in the downtrend here, just about almost all of them. Here's the estimated unrealized losses based on bank securities and loans. So they have equity of 2.21 trillion, but they've got 1.7 trillion in unrealized losses, right, on the bank securities and loans, right? So those things have to be marked to market at some point. And then finally, and this is a really interesting concept, look at the amount of refis that occurred in 2020, 2021, 2022 because of, you know, again, going back down to historically low interest rates, mortgage rates down at 2.5%, 2.75%. A lot of these mortgages are adjustable and will be coming due in the next couple of years. And so with that, I do have to cut it short a little bit today. I have my daughter's conference at school here in 20 minutes, and it's an absolute blizzard outside, so I need to give myself a little extra time to get there. But I hope that's a good summary for you. I know that's pretty high-level stuff on Silicon Valley Bank. So, Vanya, if I can, I'll open it for questions now so we can hopefully answer some questions before I have to get out of here.
Thank you so much.
Is anybody having a hard time hearing Vanya? I can't hear you, Vanya. If you have a question or something you want to bring up, Barbara, look like you may have a question. Just go ahead here. I'll ask to unmute yourself there. Yep, there you go. You should be able to unmute, Barbara.
Good. Thank you, Ryan. Very, very interesting presentation. Are there some investment opportunities in this environment that we should be considering? We know what
that's a great question. I love a good contrarian. And I think that is an absolute great question. So what happens to the capital? I mean, obviously, if we could all knew that First Citizens was going to take over Silicon Valley Bank, their stock on Monday, yesterday, was up 60%. That would have been a great investment opportunity. But the conference calls that I've been on, the bigger trend is that, unfortunately, larger banks are going to get larger and mid-sized banks are probably going to get smaller or have more regulation around them. So another Silicon Valley Bank does not happen. So mid-sized banks are regulated different than the large systemically important banks. There's, you know, different things that they have to go through testing and all that stuff with the Fed. I'm not super educated on it, but I know there's there's different tiers. More likely than not, mid-sized banks now will have to undergo more regulation and more scrutiny, which means it's going to make their rate of return on their assets or their equity lower, which means their future valuations are going to be less. In the short term, some of the banks in the mid-sized space may have been oversold. Maybe First Republic would be a good example. I'm not recommending a stock, but that's one you could take a chance on if you think that it's been unfairly sold off. I mean, they were down 90% at last I saw as of the month of March. That could be an opportunity for a bounce, especially if they get their capital shored up or they get help. But the long-term trend, Barbara, and it's a great question, is going to be a migration to the very large banks, which probably means that there's, an argument to, put some money in the best of the best, the JP Morgans, the Wells Fargos, the Bank of Americas. And again, I'm not for one over another. I'm just thinking it should be a consideration because deposits are going to have to find a new home, right? And the systemically too big to fail banks, I think people will feel confident that they're not going to be subject to that $250,000 FDIC limit. By the way, if any of you are out there holding $250,000 in cash or more, there's no reason why you shouldn't have that in, treasuries, right? Short-term 1-month treasuries, 3-month treasuries, 6-month treasuries paying upwards 4 or 5%. And if you own the securities, you're not subject to those FDIC limits because you're not going to lose the money that's in a treasury. So, consider that if you're a big holder of cash. Thank you for the question, Barbara.
I do have another question too. If no one else does, I can wait.
No, please. No, please go ahead.
The next question is on the other side, Ryan, is how secure are investments in big firms that do stock, where we might have stocks, stock accounts?
Well, you got to remember, if I have an account at Fidelity and I own 500 shares of Apple, 200 shares of GE, 400 shares of Home Depot, whatever, I own those securities, right? You may hold them at a firm like Schwab or TD Ameritrade. They're the custodian, But if, and Schwab actually has been in those, I'll address Schwab here in a second, but, you own the actual security, right? So there's no risk there, right? The risk is if you are in the securities of the firm, right? Or, bonds issued by, Wells Fargo or JP Morgan or whatever. That's where your risk would be. If I can address the Schwab thing, Schwab's been in the news a lot lately because their portfolio of what they invested their cash in compared to Silicon Valley Bank has actually done worse. They are more out on the yield curve than Silicon Valley Bank. So their unrealized loss in their their portfolio of Ron, I'll get to you next. Their unrealized loss at Schwab and their portfolio of securities is worse than Silicon Valley Bank's, but they have a big difference. Almost 40 to 50% of their depositors are like the rest of us, right? They're just, retail investors that are covered by the $250,000 FDIC limit. So they're not nearly at much of a risk of a bank run as a bank that focused itself on venture capital, private equity, ultra high net worth, where you get hundreds of millions of dollars of requested funds, overnight. So Ron, I think you had a question if you want to go ahead and unmute yourself. And then I probably have to make it my last so I can get to my daughter's conference.
Yeah, you mentioned real estate, impact of this on real estate, but in particular, commercial real estate. I saw an article the other day that commercial real estate is in for a big hit for different reasons, less demand for office space. I think this goes back to the environment in the pandemic. At UCSD, we're seeing that more people are continuing to work at home as an option and not really coming back in full force. And I think that is a general reaction across the country that office spaces was depleted. Now it's not really coming back that fast. And particularly if we go into a recession, there may be even less demand for office space. Do you have any comments on that?
Yeah. So when it comes to investing in real estate, it's idiosyncratic to what you are investing in, right? So, investing in homes and personal real estate, certainly home values are down, especially particularly out here on the West Coast due to rising interest rates, valuations, et cetera. Commercial's got a bigger problem, and it's exactly what you said. It's this social and economic and societal shift away from the value of going and meeting someone in the corner office or in the conference room. And now society accepts the exact meeting we're doing now. I haven't traveled to UCSD, since 2019, on campus because I haven't had a need to. Now that's great for the environment. I'm not driving my car there. For my health because I'm not sitting in I-5 traffic both ways, and getting on a plane, all these different things, right? That's a societal shift due to the pandemic. One that I would argue is probably a positive, right? It's better for our environment, the climate, all this sort of stuff. But it's also better for us in that we're not, commuting and spending so much time away from our families. My commute from here, if my family was in town, would be from, here to their bedroom, which is upstairs, right? Or the living room or a playroom or whatever you want to call it. It's also safer. I don't have to drive in the snowstorm. So I think some of those societal changes are good. But there's going to be a negative ramification. A negative ramification is there's going to be less office space used. And there's a lot of office space out there already available. So yes, but that is one portion of commercial real estate. There's also student housing. Well, you can make an argument that a lot of students maybe, with what happened in the pandemic and the way colleges were shut down so much, maybe not as many people are going to want to go to big universities. So maybe housing on campuses is not going to be a good investment anymore. That's a potential, societal shift. But then there's other parts of commercial real estate that may do really well. Maybe storage, right? Where people are now spending more time at home. They get the clutter and all the junk out of their house and they need a place to store it. And so maybe storage units are a good place to invest. So again, you can't, I don't think you can paint a broad brush on commercial real estate. It really depends on, whatever fund or ETF or whatever you're investing in, what their primary ownership is. And you need to look at it carefully. But I do agree with you in the article you read. There's going to be some serious issues in the commercial real estate place. And that's why I put this dynamic up, or this slide up. So with that being said, I've got about 15 minutes to get to my daughter's school. I'm sorry to cut it off a little early. Next month, I'm going to bring in a special guest, a mortgage expert to talk about the mortgage market, and with the higher interest rates, what potentially the fallout could be with mortgages, which direction he thinks they're going to go, and what he's seeing from a standpoint of refinances and purchases and all that stuff. So it'll be nice to do a little change away from equity and fixed income markets and talking about the bear market and all that stuff. We'll talk about some specific residential real estate. So thank you everyone for coming, and look forward to seeing you next month. Thanks, Barbara. Bye, everyone.